What's going on, traders, and welcome back to my YouTube channel. My name's Antonio, and in today's video I'm going to be breaking down the head and shoulders pattern and how I use it in my trading. If you're not already subscribed to the channel, make sure you hit that subscribe button so you don't miss any more content. And for those of you wondering what service we provide, we actually have an automated trading service where we will do all the trading for you. It's completely free, and all we ask for is 30% of the profits. We've been doing it for 5 years now with a proven track record. So if you want to get started, just message me on Instagram and I'll get back to you as soon as I can. But for now, let's jump straight into the video. So the head and shoulders pattern. So a brief overview of what we're going to be discussing in this lesson, an introduction, the characteristics of the head and shoulders pattern, identifying the head and shoulders pattern, trading with the head and shoulders pattern, and then also showing you guys some live chart examples. So introduction. The head and shoulders pattern is a technical chart pattern that is commonly used by Forex traders to identify potential trend reversals in the market. The pattern is named for its distinct appearance, with 3 peaks resembling a person's head and shoulders. The head and shoulders pattern is considered a reliable reversal pattern and can provide valuable information to traders when making trading decisions. So characteristics of the head and shoulders pattern. The head and shoulders pattern is a technical chart pattern that is characterized by 3 distinct peaks. These peaks consist of a middle peak that is higher than the 2 outer peaks, which are roughly the same height, okay? Not always, but roughly. The pattern also has a neckline, which is a straight line that connects the lows of the 2 valleys formed between the peaks. The neckline serves as a key support level for the price of the asset, and traders often use it as a reference point when making trading decisions. Additionally, the volume of trading is an important characteristic of the head and shoulders pattern. Typically, the volume is highest on the left shoulder, lower on the head, and then lowest on the right shoulder. This declining volume indicates that traders are losing interest in the asset and that a reversal in the trend may be likely. As you can see, this is an example, a visual representation of the head and shoulders pattern. As you can see, the left shoulder, the volume going into it is the strongest, and then the volume going into the head is smaller. And then finally, on the right shoulder, the volume that buyers are producing is at its lowest, okay? And that is why we anticipate the reversal. So, identifying the head and shoulders pattern. Number 1, we look for 3 consecutive peaks in the price of the asset. 2, we draw a neckline connecting the lows of the 2 valleys. And 3, we want to ensure and look for a decrease in trading volume from the left shoulder to the right shoulder. So trading with the head and shoulders pattern. The first thing we're going to do is look for a short position. So after the right shoulder is complete and the price breaks the neckline, traders can look to enter a short position. Traders should only enter a short position once the pattern is fully formed and confirmed, as entering a position too early can result in significant losses. Number 2, stop loss. When trading the head and shoulders pattern, traders should always set a stop loss to limit potential losses. This ensures that traders are not exposed to significant losses in case the market moves in an unexpected direction. And number 3, profit target. The profit target can be determined based on the distance between the head and the neckline. This distance is known as the pattern's measured move. Traders can estimate the potential price movement after the neckline is broken by measuring the distance between the head and neckline and subtracting that value from the neckline. So this is how we would look to enter a sell position on the head and shoulders pattern. We're looking for a break followed by a retest of the neckline to continue to the downside. And remember, traders should always monitor the market closely and adjust their profit targets as needed based on market conditions, okay? So guys, I'm now going to look at some live chart examples to see what it's like trading the head and shoulders pattern in a real live market. Right guys, so here we are on a live chart example. I'm going to be breaking down the head and shoulders pattern and how I would use it in my trading. Talk about how I would enter the market from a head and shoulders pattern as well, and basically just all the analysis into it. So let's just get started. So first thing obviously I'm going to look for is just the market structure, see if price is uptrending, downtrending. Obviously with a head and shoulders pattern, price is uptrending to begin with, and then we actually move over to bearish market structure after that. So the way I like to visually represent whether price is uptrending or downtrending is just to put on a nice trend line or something, just to see where price is moving. And in this case, I'm going to be drawing on something like this, as it is a valid trend line. As you can see, we've got 1, 2, 3, and 4 touches as well. And then obviously we did break to the downside. So price is definitely uptrending in this scenario. Now, what we want to be looking for is our 3 peaks within the market, okay? We want to be looking for our left shoulder, our head, and our right shoulder. And for me, I can see this side here being the left shoulder, up here obviously being the head, and then down here we can see that we did form the right shoulder. Okay, and what I'm also going to do is draw in some zones as well, because we can see that the area of the shoulders, the left and the right shoulder, does line up with a nice area of sensitivity within the market. Okay, we can see that this is being used as a nice level of resistance. Okay, we've got a nice resistance here, resistance here, resistance here, and then again resistance and resistance. So it's a nice area of sensitivity within the market. Okay, and this is the head of the market as well. So as you can see, as soon as we formed the head, we had a nice impulsive move to the downside. That was the first kind of initial phase, the initial move that would tell us that price is potentially going to move bearish. And then what we had was a correction from there, this kind of bullish correction back up to make the right shoulder. And then this another impulsive move to the downside was our confirmation that we are now in bearish market structure, and the head and shoulders is confirmed. What we need to do now is we need to see where the neckline is. Now, the neckline for me is through this area here, because as we can see, we have many areas of sensitivity. Actually, we've got a resistance here, that's then being used as support, and then again as resistance, again as resistance, again as resistance, potentially a support there, support here, and then we've got 2 levels of resistances through there. Okay, so there's plenty of areas within the market there that can be used to prove that this is actually our neckline within the market. Okay, so that's our neckline. And what we're going to do now is we're going to see, well, okay, how can we actually look to enter this market? We've seen that the market is now bearish. We're moving in bearish market structure, and we know that we want to be looking for a sell position. But how are we going to enter the market? Where are we going to put our stop loss, and where are we going to put our targets? And then also, how are we actually going to manage this trade? Okay, so we've got confirmation now that this is a head and shoulders pattern. I'll actually just type it in as well for you guys to see. So this is the head, sorry, this is the left shoulder. This is the right shoulder. And we can say that this is the head. Okay, but now what we want to do is we want to look for our specific entry within the market. And the way we do that, first thing we want to know is, okay, where can we potentially look to target? And we do that by looking at our measured move. Okay, so the measured move is the distance from the right shoulder and breaking the neckline. And then what we're doing from here, we're taking this exact same measurement and we're lining it up with where we're expecting price to move down from. Okay, so we know that down here is where we're going to be looking to target. And if I actually zoom out a little bit, we can get rid of this now. If I zoom out, we can see that it does line up with a nice area of support within the market. So we know it's actually a valid area to be looking for our targets. Now we want to be looking at our specific entry within the market. So what we're going to look at to actually get into this market? Well, we can see that price has done a few very interesting things. First of all, price has actually created a retail trap. So what I mean by retail trap is this area right here. We've already tested, okay, we've already tested this level within the market. We've already tested the neckline. However, the way I like to trade is I like to jump into the market later on. I don't like to be first into the market. I like to allow the market to kind of create traps, because for those of you watching, how many times do you enter the market and then you get stopped out and then price continues in your direction? And that's just probably because you're victim of what's known as like a retail trap. You're getting into the market too early and you're putting your stop loss basically where liquidity is and where you're looking to get stopped out. So I'll show you what most people would have done here. Most people would have entered the market, let's say, here, or even after this bearish candle, they would then be putting their stop loss just above the candle, just above the entry where they basically got in, and then obviously targeting down here. But as you can see, price would have literally just stopped you out by a couple pips and then continue to the downside, which we'll see. So for me, I like to enter second in the market. But why does that happen? Why have we had this wick to the upside? Yes, because we're stopping people out, but there's another thing. We always like to add an extra confluence into our trading. And the confluence I like to use with the head and shoulders pattern is the Fibonacci retracement tool, okay? And we draw it from the swing high and we drag it to the swing low. And as you can see, in this example, we have actually come up to touch the 50% Fibonacci retracement level. So that's why we like to add extra confluences just to see where the market is pulling back to. Because as we can see, this instance, we needed to touch the 50% fib level before moving to the downside, okay? So that's why we wanted to wait. Let's also look at the lower time frames now. Let's look at potentially, the 15-minute, and we're going to look at the specific candle or something to basically, enable us to get into the market. So we're going to drop down to the 15-minute. Now, on this is where we're going to look to basically get our entry. I like to use a 15-minute to get our entry essentially. And for here, after this big bullish candle, we can see we ended with a nice wick rejection into the market. Okay, so I would be looking to get in after this candle, or potentially just after we touch the 50%, and then we see price kind of come back down. Okay, so anywhere in between here, I'm kind of observing the market. So I'm waiting for this area here to be swooped. Okay, swooped, whatever it is. So this is the kind of area. Once we kind of break above this, which we did, and then we come back down, that's when I'm looking to kind of pull the trigger and enter a sell position. So let's say we would get in around, obviously we're not going to get in right at the top. It's not realistic. We probably get in around halfway between here, back in this zone, once we see price come back down. So let's say we're getting into the market here. Okay, so that's where we're going to put our entry. Let's jump back up to the 1 hour now, because this is where we're going to look at our target, which is obviously going to be this level down here. Okay, so that's going to be our target. But now, where are we going to put our stop loss? So the only logical place to put our stop loss in this scenario would actually be above the 61.8, just in case we wanted to come up a little bit further. So I'm going to put my stop loss just above the 61.8. And as you can see, it still makes for a very, very nice risk to reward ratio. It still makes for a 1-to-4 risk to reward. And how are we going to manage this trade now? So once we're in, as you can see, we'd be in profit pretty much straight away. How am I actually going to look to manage this trade? And I'll tell you about that now. So once price breaks this low point here, once we break this low point, that is when I will look to trail my stops to break even. Okay, so once we move down and we break there, I will look to trail my stop loss to break even. And then if we start to form structure, we pull back and then we continue like so on and so forth. That's how I would look to trail my stop losses. I would be bringing my stop loss down like so, like that within the market. That's how I'd be looking to trail my stop loss. Let's just play out the market and see what would have happened. So straight into profit. So as you can see, we've now broken to the downside. So stops would be at break even. We then created a new high within the market. So my stops would have been moved to there. Let's keep it going. And as you can see, we're starting to form another high here. And we're coming close to profit, so we'll be looking to potentially trail stops to there. And then price is hit. Now this is a good example because as you can see, price does exceed our take profit. So a lot of the times when you do this and you're back testing or you're even live trading and you're seeing that price is coming a lot further than what you originally had planned, don't be that person who goes, okay, I'm just going to have bigger targets from now on. You want to be realistic. You want to be taking profits from the market rather than holding for so long. Yes, okay, sometimes you can just keep trailing your stop loss into profit. But when your targets line up with, a key level of support within the market and you've done the right measurements and stuff like that, you just want to be taking profits when you can, especially when it's a nice risk to reward that fits your trading plan and your win rate, then it's absolutely fine. So just to recap, you want to be not greedy and you want to be taking profits when it's basically fit to do so. But anyway, guys, that is a pretty great example of the head and shoulders pattern, how to identify it, how to draw the zones, draw the neckline, and basically how to enter, where to put your stop loss, how to measure out your targets, and also manage the trade as well. But yeah, guys, that is the head and shoulders pattern broken down. Let's go into the outro. Thank you for watching the video, guys. I hope you enjoyed it, and be sure to leave a like and a comment. Let me know your thoughts in the comment section below. And if you're still not subscribed, hit the subscribe button so you don't miss any more content. And remember, if you want to join our automated trading system, just drop me a message on Instagram and I'll get back to you as soon as I can. Have a great week, and I'll see you in the next video.